Have you ever thought of getting involved in property development? I know more and more investors want to. I guess it's partly related to the fact that there's lower capital growth at the moment, so they're wanting to manufacture some capital growth, they're wanting to get better rental returns, they're wanting to get their properties at wholesale. So we're going to be doing a series of podcasts over the next couple of months explaining more about the property development process, and I'll be doing those with my son Bryce Yardney, who's been involved for many years now running the development arm of Metropole and been involved in hundreds of property development projects. Today we're going to start with some of the rules you need to understand if you want to get involved in property development. And in my mindset moment, I'm going to share with you one thing successful investors do, something they do differently to those who aren't as successful. Lots to learn, so welcome to this episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
With our property markets languishing over the last couple of years, more investors are looking at getting involved in manufacturing their own capital growth, getting involved in property renovations or development. Now, I first got involved in property development in the 1980s, and the team at Metropole has helped hundreds and hundreds of ordinary investors become what we call armchair developers. Since the year 2000, we've been running our development project management services. And today, I want to have a chat with you about the process of property development. It's the first of a series of podcasts we're going to do that I'm going to do with my son, Bryce Yardney. Now, while he shares the same surname, basically Bryce runs a division of Metropole and has done so successfully for a long time, our project management division. Welcome, Bryce.
Thank you.
Bryce, you started off with an academic experience on property development, but you've been handling this for quite some time now.
Yeah, I did a 4-year project management degree a little while ago. Pretty useless for what I do today, but it was good. It was a good start. It was a base to work from. And I've been in the development team now for 7 and a bit years, and I've been running it for the last few years.
Right, and you've got over 50 developments under your belt at the moment, having done hundreds before, but 50 on the go at the moment. So people are interested. They want to know, should I get involved in property development and what do I need to do? So maybe you could set out some guidelines for us, Bryce. If I came up to you and said, what do I need to know? What are the rules? What would you say?
Sure. Number one is always to get your ducks in a row before you start. Before you go out and start looking for property and get too excited, have a look at finance. Figure out what you can buy, what you can't buy. Get your finance pre-approved before you start looking. Don't go and buy something and then try and get approval. Have your ownership structures set up as well. Are you buying in your own name? Are you buying in a company or a trust? You might need some advice on that. And also get the core of your consultant team selected, like the project manager, like the architect, maybe the town planner as well, maybe the engineer as well, depends on the project. But at least have that core set up before you start so you're not scrambling later on. And you might need a bit of advice as well before you buy the property. So you might need them at the very start.
Well, in my mind, being a property developer is a bit like being a movie producer. You can't do it all yourself. Yes, you can take the film and you can edit it and you can tell people what to say and do. But as a producer, you should come up with an idea, a big concept, and then you have your team together to help you produce the end result. So, okay, the first thing is get your ducks in a row. What next, Bryce?
Number 2 is to understand where we are in the property cycle, because a development project might take 1 year if you're really lucky, but it's more likely to take 2 or 3 years, potentially even longer, depending on the size of your project. So you need to understand not only where we are in the property cycle right now, but what it's going to look like in a couple of years' time. Because if you're buying at the peak and then you finish your project and you've had a couple of down years, that might be your profit margin gone and maybe even a little bit more. So you have to understand those big picture economic factors and how they're going to affect the real estate market, how they're going to affect your development, and for the time frame that your development is going to take.
Now, that's a really good point. Fortunately, at the moment, we're at a great time. I see it as the best counter-cyclical opportunity, at least in a decade since the global financial crisis. So I think we can comfortably say in the big capital cities, particularly Melbourne, Sydney, Brisbane, our markets are going to be in a much stronger position in a year or two down the track when you finish your project. Because, as you say, you don't want to finish at the downturn of the cycle. What next?
And particularly for development sites, because they've been hit harder than anything else in this latest downturn. Apartments have done okay. Townhouses have done okay compared to development sites, which, because of people's inability to get finance for developers, for investors, for anyone that wants to build something new, it could even be a homeowner, people's inability to get finance means that development site, if you're not taking the opportunity to develop, is really just a rubbish old house. So they've been hit maybe 10% harder than anything else, which means that the ratio of land value compared to your end values or your townhouse values at the end is the best it's been in a long, long time.
That's a really good point. So, as I said, great counter-cyclical opportunity because the end value of the project has come down a bit, but not as much as the land value. So take advantage of the opportunity if you can. Okay, what would you do next then?
Then you need to do your due diligence. Don't trust the selling agent. Don't trust the ad on the website. It says it's a great development site. It says you can get 3 units on there. It's always followed by those magic words, subject to council approval. Subject to council approval is like the word but. Anything that comes before it just means absolutely nothing. So you need to do your own due diligence on the property. And that means looking at the physical aspects, the size, the shape, the slope, the trees on the site, looking at the legal side of it as well, things like covenants, easements, overlays, anything that's going to restrict you from doing what you want to do on that site. And then you've also got to look for things like neighborhood character, things like precedent. Have other people done it in the street? You don't want to be the trendsetter, the one that's fighting against neighborhood character, fighting council. That is risky and probably going to be time consuming. So look for precedent, but understand as well that precedent isn't everything. Because just because someone has done it down the street, someone might have even done it next door, it doesn't mean rules haven't changed since then. Zoning hasn't changed. Town planning rules haven't changed. So it's good to see precedent, but it's not absolutely everything.
Okay, so you do your homework, you do your due diligence on the site, on the ability to what you can put on the site. And I guess then you'd have to do some numbers, Bryce, to understand what the end values could be once you decide what you could put there.
Absolutely. You've got to get your budget right. You've got to get your feasibility right. And it's not just looking at the big numbers. There's the big ones like land and construction. They're going to be the vast majority of the money going into the project. But there's other things like stamp duty, consultant costs, interest costs. They'll add up. They'll be 10 to 15% of the budget for your development. So if you're not including them, that might be the profit margin that you thought you had. So you have to include absolutely every little cost that you can possibly think of, every dollar that's going into this development, and then allow a contingency as well. And that's going to be dependent on your experience level, your confidence in your own numbers. If you say that the construction is $1 million, but you're not really basing that on much, you probably want to allow a much higher contingency than what an experienced person might allow.
Because things always crop up. And I've found in my experience, much of it's under the ground. You don't know. I can just remember that property in Wright Street that your team are working on right now. It was right next door, 2 doors down from another one that your team built. And that particular one had all those rocks into the ground. It cost the client a lot of money. But interestingly, I know you'd allowed a contingency. And I remember when he spoke to us, he basically said, hey, it's cost me all this money. And you said, yeah, but I'd allowed for it. I didn't know what I was going to spend it on, but there it is. So yes, he was covered and that made it easier. I think a mistake I've seen budding developers do is fiddle with the numbers, fudge them, make them squeeze in to get them right. That's a mistake, isn't it?
Absolutely. And it's so easy to do. You change one number 5%, you change another number 5%, and all of a sudden it looks beautiful, but you're kidding yourself and it's going to get you into trouble.
So now that you've done your numbers, you've done your feasibility, the feasibility will let you know the maximum you can pay. Obviously, you don't want to pay the maximum, but it works back and says, if I have a particular profit margin I want to make it a viable development, that's the maximum you can pay. So you've got to be careful that you don't overpay just because you're excited and want to go ahead, Bryce.
Exactly. You can't get emotional, especially if you're at something like an auction. It's got a big crowd. It gets the adrenaline rushing. And that's when it's so easy to overpay, stretch a little bit, because that's what the auctioneer wants you to do. That's what the crowd's encouraging you to do. But this is where you have to use your head, not your heart. You set a budget when you went in there. You're not going to go over that budget. You're not going to overpay.
So now you've been fortunate enough to buy the property within your budget. You believe you're going to make money. Now it's time to get going. There's a period of time before you settle, time to get moving. What do?
Now it's time to get that team into action. The architects, the engineers, the town planners, everybody needs to start work. And you can get started before settlement usually, as long as you can get access to the site, especially if it's a long settlement. If you've got a 6-month settlement, you don't want to be waiting around. That's valuable time where you're not paying your interest bill yet. That's the best time to take advantage of it and get in quickly, start getting some architectural drawings drawn up, perhaps even be ready to go to council by the time you settle on the property.
The problem I've found a lot of people have they've got unrealistic timeframes, Bryce. They think, it's like I built a house a while ago, so it's easy. There's lots of other steps to go through. There are holdups along the way, Bryce.
Absolutely. Council and people are the biggest problem. Most of the time, processes and getting drawings done and getting engineering and architectural drawings, that's really quite simple. It's quite a simple process. As soon as people get involved, politics get involved, council get involved, neighbours get involved, that's when things are unpredictable. So you have to allow for that. You have to expect the unexpected. Things might go longer than what you wanted to, but you have to allow for that, because the biggest reason is the cost of that time. It might be 6 months, it might be 12 months longer than what you wanted to spend in council, in the appeals court, getting your permit through. You got to pay your interest bill all along the way there. So it might not even just be frustrations and going longer than what you would have liked to. That's a year of interest costs that you have to allow for, that hopefully you accounted for at the start.
Well, that's interesting, because I know in our feasibilities we do, and the interest costs a 6-digit number. It's often well over $100,000. People don't recognise that. They don't understand it. So if you don't do a proper feasibility, you get stuck. Now, I know once a year when we run our renovations and property development workshop, you and I actually put a big on the big screen there and work through a feasibility, and all the bits that you put in, all the things that you include that other people forget when they do it on the back of a paper napkin. That's the bit that makes the difference between your profit and loss. Oh, by the way, if you're interested in joining us at our annual renovations and property development workshop in October, go to realestateworkshop.com.au. There'll be a link in the show notes, realestateworkshop.com.au, at the end of October. And you can learn how to become a property developer. And you're going to get all the checklists, all the information we've got. I remember people have often said to me, Michael, why don't you write a book on property development? Well, I have, but the only way you get it is the manual that we give you, the A to Z manual, at the Renovations and Property Development Workshop, realestateworkshop.com.au. Sorry, Bryce, I couldn't help myself get a plug in.
That's okay. Shameless little plug in there, but that's all right. We'll move on.
Thank you. So we talked about being realistic with the sketch schedule. I think another thing one has to remember is there's going to be so much documentation flowing backwards and forwards. Don't trust your memory, and don't allow other people to get it wrong either. You've really got to be meticulous with your documentation, don't you?
Especially with so many different consultants involved, and everyone needs to be on the same page at the documentation stage, because if you get it wrong there, it's going to be wrong on site. And it's all good and well until something goes wrong, and then the fingers start getting pointed, and it's the blame game. Nobody wants that. So absolutely, get it all in writing, document it all really well.
We talked about a feasibility earlier on, but one of the things you've got to do is end up with the right project in mind, the right product for the end market. So you've got to know, are you going to be selling it or are you going to be keeping it, which is our preferred strategy, and who your end user is likely to be and what their requirements are, single story, double story, how many bedrooms. So what's appropriate for the main demographic in the area, and if possible, for multiple demographics, because you don't want just student accommodation or just one bedders when you've got a wider potential range of owner occupiers and investors. So you've got to design your project with the end market in mind, Bryce.
One of the biggest mistakes I see people make is they design this project to be what they want to live in, what they would like to see, which is completely wrong. You're right. It has to be with the end market in mind. It has to be what they want, not what you want.
So, Bryce, thank you. You've given us the start. There's lots more to get involved in property development, and we're going to record a couple more podcasts to help people understand the development process in much, much more detail. But the overview is that it is a great way of manufacturing capital growth. It's a way of buying your investments at wholesale because you're not paying stamp duty on the end product. You're paying it on the land. You're buying as close to cost as you could because you keep the developer's margin, but the tenant doesn't know that. So your tenant will pay you a higher rent. You get great depreciation allowance. So as an investor, it's a fantastic way to end up with a property that's got high growth because you've chosen the right area and high rental return. That's hard to get in this market, and great depreciation allowance. But a word of warning, don't become overconfident. I've seen many investors make substantial profits through property development. However, I've seen even more developers, some smarter than me, lose it all through overconfidence or undertaking just one more development before the cycle ended or not having enough margin built in. So get a good team around you. If you want to learn more about property development, join us at our annual Property Renovations and Development Workshop. Go to realestateworkshop.com.au and keep listening to the Michael Yardney podcast because Bryce and I are going to record a couple more episodes where we're going to go to much more detail about the stages of property development and renovation. Thanks for your time, Bryce.
Thanks for having me.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I want to point out to you that to be successful, you're going to have to do the opposite of what almost everybody else is doing. To find success, sometimes you're going to have to dismiss common beliefs. You're going to have to do the opposite of what most people are doing. Let's be honest, most people don't get the success they deserve. I guess what I'm trying to say this time, though, is there are so many sayings we just take for granted it's true. You better look at them. You better look at them more closely because they make absolutely no sense. For example, statements like, you can't have your cake and eat it too. Well, what's the point of having a cake if you can't eat it? You probably expected me to say that one, didn't you? Or what about this one? Don't look a gift horse in the mouth. Well, if you think about it, isn't that exactly what the Trojans should have done? The point I'm trying to make here, maybe not so well, is that if you want to be a successful property investor or business person or entrepreneur, you're going to have to think differently to most other people. You're going to have to think differently to how they think. You're going to have to do things differently to what most people do. As I've written in my book, Rich Habits, Poor Habits, you're going to need to adopt rich habits, the habits of successful people, and you're going to have to give up poor habits, those that are shown by most unsuccessful people. And it will require deep programming of many of the common beliefs and assumptions that you've come to take as true. Anyway, today I'd like to share two of these beliefs with you, suggesting that you let them go. And the first one is put all your eggs in one basket. Common wisdom seems to suggest you should diversify your investments. But is that really correct? In my opinion, it's not. In fact, I remember reading Napoleon Hill's great book, Think and Grow Rich, many, many years ago, when he said that successful people specialise. They find one area that they're really good at, and they don't diversify. On the other hand, you'll find many financial planners tell you diversify. Why? Because if we put all your eggs in one basket and something happens, like dropping it, you're going to lose everything. But I've got a solution for that. Take good care of your basket. Warren Buffett said it well. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Robert Kiyosaki put it a different way. Many financial advisors recommend that you diversify for your own protection. What they fail to tell you is it's also for their protection. Since most financial advisors can't tell you exactly what stock or managed funds is a great investment, they tell you to buy a bunch of them. They tell you to diversify. But as I said, in my mind, diversification leads to averageness. Bottom of the best and cream of the bottom. I found that wealthy people, successful people, be they a business person, entrepreneur, or investor, they've got one thing in common. They specialise. They all focus their concentration on one single earning activity. They eventually become exceptional at that one activity by continuously improving their skills, increasing their knowledge in that one activity. Despite the myth that's going around that it's good to have multiple streams of income, the wealthy very rarely engage in multiple earning activities. I remember one astute colleague of mine saying, if I try and do 5 things to earn money, I lose money in all 5 things, so I focus on doing one thing really well. So if you want to get rich, you've got to be great at something. And to be great at something, you've got to focus at doing that something. And that's where you put all of your eggs. Now, sure, in due course, you should diversify. Within property, you should diversify to different states or different types of property. I'm not saying that. I'm suggesting that businesses should have multiple streams of income eventually, but you've got to get to that point. Don't start off that way. So put all your eggs in one basket and look after it very, very carefully. The other myth I want to dispel in today's mindset session is always be on the lookout for new opportunities. Now, if you're like me, you're getting potential opportunities in your inbox every day. Opportunities like alternative investments, the next hotspot, the secret to success, the secret to untold wealth. I remember recently a client saying to me, Michael, I'm constantly coming across great opportunities. How do I choose which one to follow? In my mind, opportunities can be like obstacles if they take your focus away from what's in front of you right now. I've made more by saying no to perceived opportunities than by saying yes to them. I know it's exciting to chase the next shiny toy, but to become a successful property investor or successful at anything in business in your profession, you've got to do the same thing over and over again. You only become an expert by doing one thing 100 times rather than 100 things once. How do you know when you're an expert? When you can consistently get the same result in any market. On the other hand, you lose time and focus when you entertain new ideas, research them, find out a bit more about them. Next thing you know, you're scattering all your focus, scattering your energy. So choose one area you want to specialise in. Maybe it's property investment, maybe it's renovations, maybe it's your profession, maybe it's your business. Remember, there are always going to be lots of opportunities in any field. Make sure you're doing well with one thing. Become an expert at it. Get rich first, and then you've got the luxury of pursuing other opportunities. So the bottom line is, if you want to become rich, if you want to become successful, do the opposite of what most people do. As we come to the end of today's show, I hope you've got some benefit from it. You should know a little bit more about property development. We can explain more to you over the next couple of months in the series of episodes we're doing. And if you're really serious about it, it'd be great to catch up with you in person for 2 days at our property development workshop. Go to realestateworkshop.com.au and find out all about it. But if you did get some benefit, just like I'm hoping to help you, I'd like you to pass the message on to 1 or 2 other people. There's a share button at the bottom of all podcast apps. Just tell somebody about it. That'd do a real favour to me. Oh, by the way, I also love it when people leave reviews. And Andy Coonan sent me a review saying, I just wanted to drop you a line. And I say, I love your podcast for its simple to follow information on a range of topics. It provides a great framework for budding property investors like me. I believe the best investment is in yourself, and gaining knowledge through tools such as your podcast is definitely great value. Many thanks for this. And when you leave me a review, if you hear it read out as Andy's was today, if you just email me, michael@metropole.com.au. I'd love to give you a gift of one of my books as a way of saying thank you. In between these twice a week podcasts, why not find out more about property, success, money by subscribing to my daily newsletter, Property Update, at propertyupdate.com.au. And I'm sure you subscribe to this podcast anyway, don't you? I'll catch up with you real soon. In the meantime, spend your time wisely.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?